Welcome to Barchart's series of educational webinars designed to enlighten you about a variety of trading ideas and concepts. Let me get this started. And inform you of the tools and pages Barchart provides related to these concepts and offer you some traders insight to help you make a more informed investment decision. Today's session, the squeeze is on, profiting from volatility. Now, the squeeze is a volatility indicator developed by the renowned trader and author John Carter. Carter's squeeze indicator is a unique approach to identifying periods of low volatility and anticipated explosive price movements, which Carter calls high probability moments in time. Now, armed with this tool, traders can patiently wait through periods of consolidation and recognize when lucrative breakouts might be about to occur. So in today's session, we're going to look at the principles and components and practical applications of the squeeze, as well as explore Barchart's investment page, the TTM squeeze, and the associated chart template that is designed to complement Carter's squeeze. Hello, everyone. My name is John Rowland, Barchart's Senior Market Strategist, and as I hinted in the opening monologue, today's session is a dive into the world of technical analysis, which revolves around the understanding and the effectively utilizing volatility. Now, Carter's squeeze is a blend of two volatility indicators, which has an uncanny ability of identifying high probability greater than expected price movements. So stick around as I try to squeeze as much technical analysis into today's webinar as I can. But before we get to that, please welcome our moderator and Barchart's project director, Jean Baker. Hello, Jean.
Happy Wednesday, John. How are you doing?
Day.
Yeah, hump day.
I'm doing fine, and you?
I'm good, thank you. Yeah, very busy here at Barchart, but today's good day. It's Wednesday. Week is halfway over.
Squeeze all that work in today?
Yes, I am. Yeah, I am. Well, I know you have a packed full agenda here, so whenever you are ready to get going, John, take it away.
Thanks, Jean. Thanks a lot. All right, just a reminder that today's session is for educational purposes only, and decisions to buy, sell, or hold or trade securities, commodities, or any other investments involves risk and are best made on the advice of a qualified financial professional, and under no circumstances shall we be liable for any loss or damage you or anyone else incurs as a result of any trading or investment activity that you or anyone engages in based on the information or material you receive through barchart.com and our services. I also add that today's session is my interpretation of John Carter's squeeze. So what is the squeeze indicator? Well, John Carter is a renowned trader and author, and he has contributed significantly to the field of technical analysis. And one of his innovations is something called the squeeze, which can be found in one of his books, and the book that I'm referencing here is Mastering the Trade. Now, the squeeze indicator is designed to identify these periods of low volatility in the anticipation that there's going to be a potential explosion of price movements in these many different financial markets. So the concept behind the squeeze revolves around this volatility, right? Volatility-based indicators that help us identify low volatility. And these low volatility events often precede high volatility breakouts. And the aim is to capture the potential explosion in price and using these volatility indicators to find those significant market shifts. Now, the indicator is based on this idea that markets alternate between low volatility and high volatility periods. And when the volatility is low, it's similar to like a coiled spring, right? Energy is being stored up. And the implication is that there might be an imminent price movement. So as the market consolidates, it builds up pressure and it sets the stage for a breakout. And that building up of pressure is what we call the squeeze. Now, the reality of markets is that markets spend more times in periods of consolidation or sideways trading. It's about about 3/4 of the time you will see markets will be in this, what we would call a low volatility period, and only really have these impulses or trend type movements only about 1/4 of the time. And so this is what the squeeze is going to help us identify when these low volatility events occur, but alerting us when we move from low volatility to potential high volatility. And when the indicator fires, that is a confirmation that the volatility is increasing and that our price is about to break out of these tight trading range, either in one direction or another. So the components of the squeeze incorporates three main components. Two are volatility indicators, and the third is histogram. Now, the name the squeeze could be contributed to one of the volatility indicators, are Bollinger Bands. And if you're not familiar with Bollinger Bands are a measurement of volatility based on a standard deviation. And you're going to get three lines. You're going to get outer bands and then what we call a mean, or the middle band of a moving average. And so what happens is that the Bollinger Bands, the outer bands, get squeezed inside of Keltner channels or Keltner bands. Now, Keltner channels or Keltner bands are similar to Bollinger Bands, but they use the average true range to measure volatility. And they are based on an upper and lower channel. So as the Bollinger Band gets squeezed inside of the Keltner channel, this is a time of low volatility. And then the third component is a momentum histogram. Now, Carter's squeeze employs a momentum histogram, which is similar to a MACD, if you're familiar with a moving average convergence divergence. But this is used for two purposes, and that is, the first is to confirm the direction of the potential breakout, and second, to help identify the velocity or momentum of price movement after a firing, as the initial energy, or that squeeze energy, is released and starts to wane. So how can we use or utilize the squeeze, and how do these different components work together? So what I want to do first is I want you to understand the concept of the squeeze by visualizing it. And so what I've done here is I've created a template that mimics the squeeze. In other words, the pieces are relatively the same, and so that you can visualize what is going on when the squeeze happens. So what are we looking at here? First of all, the red lines represent Bollinger Bands. And again, Bollinger Bands are defined by two standard deviations around a moving average. The default is a 20 period. So we're looking at a daily. So we're talking about a 20-day moving average. The purple lines are the Keltner bands, and they represent a 1.5 ATR, average true range, over a 20 period look back. In this case, again, we're on a daily chart, so we're looking at a 20-day look back period. Now, as both Bollinger Bands, you can see here by red, get squeezed inside of our purple bands, this identifies that we're in a state of the lowest volatility of our underlying asset. Now, looking at the MACD below, which is a little bit different from Carter's histogram when we look at it, but notice how the MACD is flat. It's really telling us we have a trendless market. So what I'm going to do here is I'm just going to create a horizontal line. And let's look where the red lines come inside of the purple. And that's right about there. So this is what we call the squeeze, or the triggered, or the triggering of the squeeze, the beginning of that coiling of energy. Now the trader needs only to wait until one of these Bollinger Bands breaks out of the Keltner bands to fire the squeeze. And this would be a sign that we're going to release that energy, or that return of volatility. Now, again, I just want to use this as a visualization. And so looking at all this, you might be a little bit confused, or it might be difficult to interpretate. But Carter does have a template that Barchart has adopted, which is a lot easier to read and a lot more actionable. So back up here again, where we will find our access to our templates. Under bar chart templates, you can go in here, and these are some default templates that we have created, and you can see TTM squeeze, trade the market squeeze. And I'm going to click on that, and it's going to load up the squeeze template. Now, what do you get inside of this template? Well, first of all, you get 3 EMAs, or exponential moving averages. So the exponential moving averages are going to help us in a couple of ways. First, they're going to help us in determining potential price movement. But mainly, we're going to use them for risk control measures, which we'll look at in a moment. You get a candlestick chart, and you get a histogram pane, which is down here. Now that's going to offer you 2 pieces of information. Foremost, I want you to look at these green and red dots. Now remember when we did the visualization on the components, what I did on the first template, where I drew this vertical line where I identified where the Bollinger Bands were inside the Keltner bands, and that had triggered the squeeze was on. Now notice that our dots here change from green to red. And the red dot is created by the condition of the Bollinger Band inside of the Keltner channels, and the setup before the release. So I've just changed our stock here. This is Wingstop. And again, let's concentrate on our histogram pane. So here we see our green dots, right? And then we get that first red dot that is indicating the setup, the squeeze is on. And then we get a green dot, the first green dot, and this is what we call the firing. So red dots can be just one dot, or it could be several dots, but there's only one firing per squeeze. In other words, the first green dot is that firing. Now, what we can do with the histogram here also is it's going to tell us what type of position that we're going to take. So if the histogram is above 0, as this one is, then we'll take long positions. If it's below, in this color would be pink or purple, then we would take short positions. Now, Carter also adds confirming the decision by looking at our EMAs, our exponential moving averages. And what he wants to see is something called in stacked in terms of the lines. Now, in other words, what he wants to see is that the shorter term 8-period EMA is above the 21 and the 21 is above the 34. And if possible, all of the price action is above all three. To him, that would be an excellent example. So for in this case for Wingstop here, we do have a firing on this day right there. And you can see on that day, our EMAs are stacked and our price action is above all three of those EMAs. So this would be a good candidate. So any divergence from this, in other words, if our price action is not above our EMAs, or our EMAs are in reverse, maybe they're stacked the other way, or that our histogram is not confirming the price action, in other words, a buy squeeze or a sell squeeze, all these divergences could create false or ineffective um, signals. But let's switch back to that visualization template. And again, right, I've taken the squeeze off, but you can see where our red lines are inside of our purple. The squeeze is on. And then here's our Bollinger Band that went outside of our Keltner band. So you only need one of the bands to be outside that fired the squeeze. And again, our MACD is a little bit different from our histogram on the squeeze template, but notice how the MACD has turned to the positive, and this would be giving us that permission to take a long trade. So using the squeeze. So how can we effectively use it? So there's a very easy systematical approach here. So first we're going to identify that squeeze. We're going to look for the periods when the Bollinger Bands are inside the Keltner bands, and that's indicating that low volatility. So this will be represented by that red squeeze dot. Then we're going to patiently wait for confirmation, wait for that green squeeze dot to fire, and then use that momentum oscillator to confirm the breakout signal. Now we're going to take a position once that squeeze is confirmed, and traders will consider taking a position that are in the direction of the histogram breakout. Again, above the zero line, enter into long positions. Below the zero line, enter into short positions. So let me just kind of go through these rules one more time. We're going to identify the squeeze by the red dots. We're going to wait for the green, the firing, and then we're going to confirm the firing by looking at our histograms and also our EMAs. We kind of want to look for those stacked EMAs. Now, this is where being a Barchart subscriber starts to get interesting. So you could scan a lot of markets. You could scan, hundreds of markets using this template all day. But what is really cool is under our investing page, down here, you will find something called the squeeze. And if you open that up, you're going to get 3 stages of the squeeze. First of all, the triggering, the red dot, and 2 firings, the long squeeze and the short squeeze, the green dot. The long squeeze is where our price movement is above our histogram, and zero line, and our short squeeze is where price movement is down or below the histogram zero line. Now, right now you can see for instance, in the triggering, which is kind of interesting, I thought today was you have, if I scroll this all the way down to the bottom, you have about 500 stocks, and this is over, the Dow, the S&P, the over the counter NASDAQ, but you have 500 stocks that are in what we would call low volatility placement. So let's go to a long squeeze here, and I want to kind of show you a couple features here. First of all, again, these are all the stocks that are firing a long squeeze today. And I can come in here and screen on them. Now, from this point on here, screening, you need to be a subscriber of Barchart, either a plus or a premier. And what I can do here is I can see the results of the long squeeze, and then I can save that screener. Now I could add other elements to my screener. In other words, I could say, I want to see a certain price movement, or I want to see above a high or low, or maybe some other technical analysis. One of the things that we can screen on is, does these equities trade options, which would be something we'll talk about in a little bit. But you might have some fundamental values that you want to look at as part of your screener. And then once I save that screener, I can name that screener, and then I have that screener every time. Now, as a Premier member, you can have that screener sent to you on a daily basis. So what it does is it scans the market for you, waits for those setups based on your other criterias, which is a nice little feature. All right, so I'm going to go back to the squeeze. I'm going to go back to the long. And let's follow what it says here. To view visually, open flip charts and open that bar chart template. So let's do that. So I've opened the flip charts, and again, up here in the right-hand corner, this will say templates. Now mine is already defaulted to a template that I use a lot, but I'm going to go into bar chart template, and here it is, TTM squeeze, the same way I showed you before. So again, let's talk about some nuances inside of the squeeze in terms of like the dots and the moving averages and whatnot. So, you can get a squeeze based on just one dot. In other words, the Bollinger Bands come inside the Keltner Bands for just one period. But sometimes you might find that might be enough time for that energy to coil. Another aspect is if your EMAs are in contradiction to your squeeze. For instance, here we have our squeeze is on, our histogram is telling us we could take a long, but look at our EMAs. Yes, they're upsloping at the moment of the firing, but what we see is our shorter term EMAs are below our longer term EMAs. So that might be a not effective squeeze indication. In other words, this might fail, and you can see that exactly is what did happen. Price did move back lower and didn't continue to move higher. The other aspect that we can think about is if we have a contradiction of our firings. For instance, here we have a nice long squeeze, we get a firing, right? And there is no histogram confirmation. You can see our histogram here is basically zero, right? It's not really giving us any indication. And maybe we would thought it might be a buy squeeze, and because this was, for instance, we're in the long squeeze, but we can see that our price action and our EMAs are kind of flat and still below one another. But here would be a better or more productive or effective squeeze. We get a nice long squeeze, we get that coiling of energy. Our histogram has turned to the positive. We get the firing, and you can see that both of our EMAs have turned to the positive, and they have crossed over the longer term EMA, a much better squeeze candidate. So again, let's just kind of sum this all up. We're going to wait for that firing, right? We're going to use caution, right? We're going to be patient, and we're going to be better served waiting for those squeezes of potentially multiple red dots where our EMAs are stacked. In other words, are projecting in the direction of our firing, and our price action is confirmed by our histogram. So I looked at today's candidates from the long side, and the only one that really exemplifies what we're talking about would be this one, Seneca Foods. And again, notice here we get a nice long period of a squeeze. We've got a firing, right? Our histograms are in the positive. That tells us we can take a long position. And look how nicely our EMAs are stacked. So again, probably a more effective signal in terms of our squeeze. So let's look at the opposite. Now, let me see you. Here's Bullfrog, and I was looking at this morning. And again, you know, we have a squeeze was on, and here's the green dot firing. And again, what is our price action? Our price action today is down, right? Our price action is down. Our moving averages are stacked, but they're stacked in opposite, right? They're stacked in a downtrend. So even though this is turned out to be a buy signal based on the squeeze analysis, this would not be a good candidate. Now, in order for us to take a buy signal on this one, I think we need to see a couple elements here. First of all, I would like to see our price action above our 34 EMA. I would like to see a greater histogram, just not barely over zero. And obviously, we probably want to see our EMAs cross over from the shorter crossing over the longer term EMAs. So again, patience on this one, right? Now, this might end up being a short squeeze, but we don't have all of that information just yet. Okay. So managing risk. So in his book, Carter offers, you know, a couple of several different risk management techniques, and we'll look at a few of them in a few minutes here. But he admits that he likes to jump the gun, and he likes to use intraday squeezes, for instance, a 1 hour time frame or a 2 hour time frame to find trading opportunity. But he suggests a case for using higher time frames, for instance, like the weeklies, to help you guide your lower time frame trade plan. Now, some of you might say, well, you know, you might think that a weekly time frame is too long, you know, considering when we talk about how long a squeeze usually lasts for. But you know what he's saying is pay attention to weekly squeezes, and if they're firing, what you don't want to do is take a smaller time frame trade that fights or is against a weekly squeeze. So let's go back to our long squeeze, back to our flip charts, and back to Seneca. And I'm going to have to change my template one more time. And again, here we are in a daily chart. We're getting a daily long squeeze, and let's change our time frame to weekly. So this will be a 3-year chart, and each one of the candles here represents 1 week. And so notice what we see here is that we have just recently had a squeeze and firing, and that firing gave us that long indication, right? A positive histogram and again, positive stacking of our EMAs. So taking a long squeeze at a shorter time frame would make more sense because we're seeing it being dominated by our higher time frame weekly. What I don't want to do is take a short squeeze, for instance, in a daily or an intraday time frames, because I'm fighting this higher time frame, squeeze. So there's some other rules we can use in terms of managing our risk. So, any trading strategies you have is really important for you to understand risk and, consider setting up stop loss orders. Again, maybe a stop loss order might be something we call a hard stop, where we just want to protect ourselves from crazy price movements. But we might use soft stops. In other words, we don't leave them in the market. We just exit when our system or our market is setting us different signals. And they're all based on this idea that we want to protect ourselves against adverse price movements, or as we start seeing profits, we might use trailing stops to secure those profits. So one of the things you can do is we'll look at our initial risk, and that could be measured by where is the high and the low of the bar that gave us that firing, that green dot. And then we're going to set our stop opposite of the direction of the trend. In other words, if I get a buy signal, I'm going to set my stop below the low of the bar that gave me that firing. Now, I might not set my stop right on the low. I might use a risk tolerance based on my personal trading profile. And so Carter says something like you could use a 2 times the ATR over the last 14 days and add that to your, in this case, low. Again, when we look at this in real time, what we'll probably discover is that those EMAs that we just went through are relatively good estimations of where we probably want to put our stops. So the other thing that we can start thinking about in risk management is after the squeeze fires, right? So Carter tells us that on average, or about, the squeeze usually, the firing phase usually extends for about 8 to 10 bars. Again, depending on the time frame we're looking at. If I'm on a daily, and that's 8 to 10, could be 2 weeks. If I'm at an hourly, that means that could be 1 day. If I'm looking at a weekly, we're talking about a couple months. But when the histogram changes, or the histogram colors start to move back towards the zero line, this would be a time to start considering exiting the trade. In other words, the energy that has been released from the squeeze is starting to wane. So Carter recommends that exiting a trade when you have 2 bars in a new color. For example, if our squeeze fires and it's above the zero line, you're going to get blue bars. And when they change from light blue to dark blue, after 2 dark blues, then consider exiting that trade. Again, let me go back to my flip charts and Seneca and so let's kind of go back in history. Now, the example I wrote in the slide here was about blue bars, but we can do the same thing with our pink or purple bars. So for instance, here we got a squeeze, and then we got a firing, right? Again, our histograms are moving lower. That would indicate a short position. And you can see that our momentum will continue to increase. Now, Carter would say, when you get 2 bars that move, or shorter bars that move in the opposite direction of your initial momentum, that would be an indication to exit that trade, and that would be right there. Now, there is a nuance here, and again, this is not a textbook example because it's just a little bit off. But what you can do is on that second bar, and this is what I do, on this second bar, if it's not below the previous peak bar, in other words, this bar here, if they're about the same, which these again, yes, it is uh, theoretically lower, so that would be that exit signal. But if they're relatively the same height or the same size, you could stay in this trade, and what you're just going to wait for the first bar, in this case, this bar, that is below that previous bar that is one before your pink. So that would allow you to stay in the trade longer. But again, that might mean you might have a reversal of price action, and that might limit it. Sometimes might limit your profits. But again, that would be a nuance that you could use. So when you get those two bar changes, that would be the indication of exiting that trade. Now, the other thing I was saying about using our EMAs is you could use your EMAs to help you tell when you want to exit a trade. And, again, you depending on your risk tolerance and how much you want to capture, if you get a close inside of that first EMA, that 8 EMA, that might be an indication for you to exit. And notice how that does line up with this bar here. And again, here is that bar that you would have exited that trade. And so where did we really see that change? Again, that would have been here where we closed inside of that 8 EMA. Again, you gave back more on this example. Here, you protected a little bit more. So again, this is really up to the individual trader in terms of how they want to set their risk tolerance in terms of givebacks. Now, the other thing that Carter talks about is using our average true range. So I can go into more data, and under the technical, you can see where it says 20-day ATR. And so let's look at all technicals. And you can see that we do offer you a 14-day. And so the 14-day average true range for Seneca is 127, or let's just round this off, saying $1.25. So what could I do? Well, as I reach that peak, I could set a trailing stop. And again, the example that Carter gives is 2 ATRs of your 14 period. So 2 times 125 would be $2.50. So you would use the closing price or the low of the candle that is creating your peak, and you would set your stop, your trailing stop, $2.50 from that. So that in this case is we have 45.18 and we add $2.50. That would give us 47.68, right? 46, 47. 47, let's say 70, and that would be right about here. And notice how closely that comes in line with our 8 period EMA. So again, I'm just showing you some different techniques that you can use in terms of doing some trailing stops. All right. So understanding volatility, and that is a short-lived play. The squeeze is really optimal performance ranges from those 8 to 10 bars, as Carter presented. So if we're looking at a daily chart, then we're talking about about a 2-week period. So we want to try to maximize the payout or the potential of the squeeze. So using options is a really good way to leverage the effectiveness of strategies in terms of strategy choices. So Carter advocates a couple of things here, the three possible option strategies. For instance, for longs, he likes to buy in the money calls with a 70 delta. Now, what this does is it is kind of twofold. First of all, you get the leverage of options. In other words, I can take control of a lot more stock for a lot less capital. But I can also use options in terms of risk reward management when we start using those ATRs. But if you're not familiar with delta, so a delta tells you how much your option is going to change based on every $1 move in the stock. So again, if I'm using a 70 delta, it means for every dollar change in my stock, my option is going to change by 70 cents. In other words, I'm getting a lot more effectiveness of my option. It's acting more like the stock. If I buy an out of the money option and I get a big price movement, my out of the money option might not, especially if it's a low delta, let's say it has a delta of 20, I'm not going to get a lot of price appreciation over that, that 8-day period. So again, I want to try to find an option that's going to act more like the stock. So unfortunately for me, uh, uh, I wanted to do a couple of analysis here with Seneca Foods, but Seneca does not have options. And so again, one of the cool things we can do is we can come here in the long squeeze, and I'm going to set my screener, and I'm going to say, okay, screener, of these long screens, which ones has options? And then I'm going to add that and then look at the results. And so these are the ones that have options. Now, I looked at a lot of these candidates earlier today, and a lot of them do have options, but they don't trade a lot. For instance, most of these have very small volumes and very small open interest. So again, if I'm doing any kind of option strategy, I want to make sure that I have a lot of open interest and a lot of daily volume. That'll make it a lot easier for me to get in and out of the market. If I have a stock that only has maybe 1,000 open interests or only trades maybe 100 options a day, yeah, it might be easy for me to get in, but getting out, I might have to give away a lot of profit, or I might have to give away a lot of risk in order to get out of a trade. But let's go back to our Walmart example, because I think what is nice about the Walmart is even though it's not firing today, as we showed here, but maybe you can use this to watch over the next few days because we are in the squeeze. And because if I look at the options pricing here, for instance, you can see just on these options, you got a couple tens of thousands of options, and then look at your volume. So this would be a good options candidate. So the first thing Carter says, well, let's look at, excuse me, not trading strategies, whoops. Let's look for those options that have 70 deltas. Now, if I'm going to buy options, I want to make sure that I buy time. What does that mean? Well, I want to be outside of, let's say, 30 days or 60 days, because then the theta decay will not be as great. So for instance, let's go to like the June 21st. That's 51 days out in the future. And Walmart is now trading currently around $59. So I want to look for the strike that is has a 70 delta. So I can come over here, and here is the 56.67. Now, why do you say is this a kind of a weird number? If you're not familiar with Walmart, they just recently had a 3-for-1 split. I think that was back in February. So you're going to have some kind of crazy strike prices. Some of you might be more familiar with, might be $1, $5, $10, that kind of thing. But you're going to get this kind of crazy options for Walmart right now. But the point being is the trade you would be looking for would be buying these 56, 67 call options if you got a call along, or if we were looking in the case in Walmart, which kind of looks like it's leading towards a potential sell squeeze, then you would have your choice, between let's see, a 63.33 or a 61.67 option for that analysis. The second strategy that Carter will use is he will sell an out of the money puts for longs or sell out of the money calls for shorts. And again, if we're taking a long and we're going to sell puts, well, we're going to look to set our short puts below our EMAs. Again, if we go back to our Walmart chart, and this is again where that part of that process, just work with me here. If we were thinking about a long, if we were going on a long squeeze, then we would sell puts below our EMAs. But because it looks like it might be a short firing, then we would look to sell calls above our EMAs. And then the other one, what we can do that Carter recommends is we can buy at the monies, either buy call spreads if we're long, or in this case, we're going to buy at the money put spreads for a short. Again, if I'm going to buy options, I want to make sure that I have time and don't want to worry about theta decay. So currently we're at right around, $60. So again, I'm going to go to my options pricing. And again, I'm going to have a little bit less theta decay on these 51 days. And so I could buy the 60 put and then sell, let's say, for instance, a higher strike put. And so try to capture that trade. All right, so one more feature I want to kind of show you in terms of our investment ideal of the TTM squeeze. So I can go into, let's say, a watch list. And for instance, here's the Dow Jones, right? Dow Jones 30. And I'm going to go back to our screener. And over here, I'm going to go down and I'm going to scroll down to technical analysis. And there's all these different technical analysis we can, but at the bottom down here, you will see TTM squeeze. And I'm going to add that. And so what I'm effectively doing is I have a watch list of stocks that I am familiar with, that I feel comfortable trading, that I know has options. And I'm going to add that. And then I could say, well, is the squeeze on, the red dot, or I'm only looking for longs, or I'm only looking for short trades that were triggered today. And I'll see if that result. Now for today, we have no results. But again, I could save this screener, and depending on the category of subscriber I am, either a plus or premier, I could have that watch list screened every day and then alert me of those potential opportunities. Now I'm just curious on the Dow today, no longs. Let's see if we got a short. I'm just curious. Let's see if we get a short. No shorts. But I know that if we go to the squeeze is on, I think a couple of them are in the squeeze. Yeah, there you go. So again, for reference, there's our Walmart. You got Visa and Honeywell. So again, those give you a little hints. Maybe you can watch those over the next 3 or 4 days. Okay, so Gene, let me do this for a second. Let me take a couple of questions here, and then we'll wrap up today's session. Okay.
While John is reviewing our questions, just want to remind everybody that if you are intrigued by this, and if you want to start playing around with screening on that TTM Squeeze investing page, or by using the stock screener and the filter that John just showed you, we do offer a free 30-day trial for our Barchart Plus and our Barchart Premier memberships. It's a great way to get your toes wet in the water, so to speak, and to start looking for some of these great trading ideas.
All right. So Jeff asks, can we use weekly timeframes to confirm a shorter term strategy? I think Jeff, I think I kind of went through that process, and Carter definitely says that you want to keep the weekly in mind, right? Not necessarily have to trade it, but try to avoid taking shorter term trades that are in conflict with a weekly squeeze. In other words, that example that I gave you with the Seneca. So Russ asks, why not add volume to a value of the screener? So Russ, yeah, again, we're just talking about the squeeze. And again, if you understand volume and, that volume increases on breakouts or increases in volatility, that is a really good indicator. If that's something that you use, personally, that's something I look at as well. Yeah, why not add that to your screener? So the question is, um, again, I think I showed you that you can screen on, does a stock has options, and that is a good way to get through a lot of these over-the-counter stocks. If you go through the investment page, you'll discover that there's a lot of stocks that are kind of just languishing around, or they're trading, they're $3 stocks or $5 stocks. Yeah, they might have some great potential in the long run, but it might take a while for them to come to fruition. Um, uh, so I'm just kind of reading some of these here. So Mace, we got a nice comment from Mace. Mace says that she's a member. I'm guessing Mace is a female name. I don't want to make that assumption. I'm sorry. But you're a member, and then on the you've used this on other platforms, but that today's presentation really gave you a better understanding. So I appreciate that feedback. And yeah, I think John Carter is a genius in his own right. And so I really do like this setup. And in fact, in the previous webinar I did on this one, I was not aware of it. And as I was doing my research and processing, I was like, wow, this is very cool. I mean, I do use Bollinger Bands in terms of volatility trading, but I really kind of do like this. But I can't caution enough for you is that not every squeeze is a great trade. And in order to find those really good ones, look for those characteristics that I just talked to you about. Looking for the histogram that is in conjunction with your price movement. Look for those EMAs that are reflecting that price movement, right? And then use other technical analysis in terms of, if I have a squeeze and then I'm breaking out of a monthly high or a monthly low, that is also a nice little add-on. Danny says earnings can create a lot of these setups. Yeah, Danny, I would try to avoid doing squeezes going into earnings because you could get, the old reversal on you. So yeah, I do like squeezes though that occur post earnings, right? Sometimes you get those. You'd be surprised. Um, oh, May, sorry about that. May's telling me it's a he. So again, he's a he. So Mace, I apologize. I have a friend. Her name is Mace. I know that's kind of weird. Um, So Robert asks, you first said that 2 times 14 ATR minus the low bar at the firing, and later you said you could add that from the firing. So what I'm really talking about is two different techniques. So the firing, the initial, right, the initial firing, you want to make sure you have some kind of risk tolerance, right? So you could use a 2 times ATR based on the high or the low of that fire. And again, you're going to set that stop, or you're going to decide that you're going to exit that TTM squeeze is not working if you move two ATRs, 14 period ATRs from the high or the low of the firing bar. The second time I showed that example of the 14 ATR, it comes under the ideal as you're peaking, as you're getting into that fifth, sixth, seventh, eighth day of the squeeze, we want to start setting some trailing stops to protect our profits, right? Because what we don't want to happen is, tomorrow we wake up and the stock has reversed, $15, like Tesla just recently did. So we want to make sure we have a stop in place, and that could be what we call a trailing stop. And so that trailing stop could be based on, again, those EMAs or the high or low of the peak candle of our histogram. Again, um, let me see if I can really make this stand out for you. So here we are peaking out. We're now what, 1, 2, 3, 4, 5, 6, 7 days, right? Somewhere around 8 to 10. So on this candle here, where would we set our trailing stop? Well, it would be 2 14 period ATRs from, now you could use the high or you could use the closing price depending on the type of trader you are, or there's something called the chandelier method where you would take the lowest point, right? We don't want to give back, a lot of our profit, and you could use 2 ATRs from there. So you could add 2 ATRs to here, and that would probably put your stop, right in this area. So there's a lot of different techniques you could use. I'm just kind of giving you some examples. All right. How would I trade penny stocks? Well, first of all, I don't trade penny stocks. I do feel that trading penny stocks, you add a lot more volatility because of lack of liquidity. And again, I haven't tested this on penny stocks, so I would say I'm going to have to defer that question. I'm getting through a lot of these here. All right, so let me do this. I want to finish up because I do have a couple of takeaways. So listen, if I didn't get to any of your questions, or you really have a desire to have your question answered, please send your questions to support@barchart.com. And our crack staff will help you out with it. And if they can't answer the question, they will pass them along to me and see if I can help you out. So if you have a burning question, go ahead and send those. All right, so let's just kind of sum up our session today. So again, the TT indicator is a little complicated in terms of its components, but our bar chart template and our investing page makes it really easy and to read and also make it actionable. Again, traders need to wait for the squeeze and then to fire, right? That green dot, and then ride that histogram wave or that momentum or that volatility, however you want to define it, to profitability. But again, making sure that we're patient, and we have that checklist of things that we need to look for: histograms, EMAs, and price action. Now, again, remember, there's no such thing as a perfect indicator. And as much as I admire John Carter, it's important for us to understand risk management in terms of trading, and that this particular setup is very reliable if our indicators probabilities are in higher time frames. So let me kind of say that in other words. I would rather take daily and weekly TTTM squeezes than intraday squeezes, because a lot of the intraday ones will not give you the effective volatility breakouts that you want to maximize your profit. Not saying that you can't do it, and not saying that there aren't opportunities to do that, but I would be concentrating more on dailies and weeklies. And if those are firing in one direction, then if you feel the notion to start trading intradays, only take those intradays that are in concert with your higher time frames. Okay. Well, folks, let's see. As Gene has said, we have a Premier and Plus package you can try out. The subscriptions are very reasonable in terms of, like a one visit to Starbucks. It's probably cheaper to have a monthly subscription to Barchart. But you can try us out for 30 days on that Premier and Plus package. So I would say that is a low risk trade, actually a zero risk trade for you, as to give that opportunity. All right, so next week, I think we are off, and yes, we are off next week, right, Gene? You don't have to answer me, Gene. I know that answer. Upcoming webinars. So we don't have one on schedule, but I will let you know that in 2 weeks, we're going to have a very special guest, and we're going to do an investment webinar. We're going to look at the infrastructure of the electrical grid or the power grid, and look to see if there might be some trading opportunities, long-term investment opportunities. And I happen to have a friend who's been in the business, the energy procurement business, for about 30 plus years, and he's going to come on and give us a lot of insight into the electricity world. So I think if there's something that you're interested in, I think that's going to be a fascinating webinar. And that is in 2 weeks from now. That'll be May 15th. So until then, folks, I appreciate your time. Stay healthy out there, manage your risk, and the good of all trading.